Guys, we're going to go through 3 stocks that are at 52-week lows right now. Walgreens, Twilio, and Verizon. So let's start with Walgreens. This is probably the one I'll be most interested in. Let's take a look at it. So Walgreens is sitting at $36.79. It hit a high of $55 back here in January. Now you would think Walgreens went through, and I'm going to go 5 years here just so we can see what happened during March of 2020. This was your COVID time. And actually, instead of getting that big spike that a lot of companies had, it kind of chilled out, went sideways, got a little bit of a bump, but they didn't come to these 2019 highs of about $80, which is quite surprising with everything that was going on in the world with vaccines and going and getting vaccinated and whatnot. And honestly, Walgreens is a great store for you to go and just pick up a couple of items here and there. So let's look at their 8 pillars, first of all, because this is a hot topic stock for people in the EM community. 5-year PE of 9. That draws in a lot of people right there. Return on invested capital, I wish it was a little bit higher, but it is what it is. Revenue growth is growing. Another debt situation. This is something that concerned me until I went and looked in the 10K, and I'm going to pull that up. I'll just pull up the financials, actually. They have a lot of lease obligations. That's a big part of that for them. Now, something that I really love, buying back shares like nobody's business. That is something really nice. The free cash flow we're going to have to take a peek at, but they're at a 52-week low. So let's go to the income statement real quick and see what kind of growth they have. Now, I would think, initially I just hear Walgreens, CVS, whatever, and I just think instant bump in 2020, and that wasn't the case. They kind of got it in 21. They've kind of returned to that profit revenue of 2019, but it's still hasn't climbed to that level yet. Let's see their net income real quick. Net income is way up from 2020, and it has surpassed their 2019 levels, which is great. And now, of course, the shares outstanding. They are just buying back shares and helping out their shareholders so much. Speaking of helping shareholders, do they pay a dividend? They pay a dividend of 5.1% forward dividend, $1.66 billion out of $3.44 of free cash flow. So they can definitely afford that. It might be a little bit rich, but it's not terribly concerning for me. Now the debt situation. Total current assets of about $19 billion. Total current liabilities of $24 billion. So that right there starts to worry me. But I'm going to come here and look at their lease obligations, $5 billion. And it has, honestly, it's been fluctuating over the decade, but it's kind of in that middle range now. You see they went as high as 10.29. They went as low as 3.57. So they're kind of sitting in that middle range. They are opening more stores. They're working on, I don't know what the name of it is, but they're looking at these kind of health hubs, similar things that CVS are doing. So they're trying to get into that. You go in there and you get your checkup from a doctor in there. Now, let's go to Stock Analyzer real quick. Actually, before I go to that, I pulled up this article from CNBC, same store sales, because that's a very important thing when looking at retail. Same store sales in the United States for everything, including their store fronts, not their pharmacies, was up 2.4%. In the UK, same store sales for that area was up 24%. Now, the pharmacy division was up 2% in the United States and fell over it was up 0.4%, dropping. That's a big fall from where they were at. So something that we got to pay attention to, but nothing is making me shy away from this company just yet. Let's run it through Stock Analyzer real quick. So let's put in pretty low numbers for revenue growth. Let's start with 1, 4, and 7. They've done that over the past 10 years. They didn't really get that COVID spike, so I'm comfortable putting that level in. Let's go 2.5. I'm going to go low. 3 and 3.5 for profit margin. Free cash flow margin, I'm going to do the exact same thing. 3 and 3.5. PE. So the PE, I'm going to go 12, 14, and 16. This is a company that doesn't necessarily have a lot of room for growth. And if they do have room for growth, it is going to be very capital intensive for them with opening these new health hubs and getting people to get doctor's visits at their pharmacy. So let's see. And this is why people love it, because you go through here and you look at this 32-week low price and it hits on all cylinders, even a very low end where I put in there 1% revenue growth over the next decade, 2.5% profit margin, which is not their 10-year average, is certainly not their 5-year average, and certainly not their 1-year average. PE of 12. This is why people are interested in this stock. The next one, Twilio. So Twilio is cloud-based communication. So as we get into Twilio, I want to remind you guys, watch this video again. Go through what I just went through on Walgreens. See where I get these assumptions from and trying to get that thought process, and go and watch other videos and do the same thing. See the repetition of the thought process that I have. So Twilio is a cloud-based communication platform, a service company offering communication building blocks, yada, yada. Now, first thing I notice about this company, They don't have a dividend. I mean, sorry, they don't have a dividend. Well, they don't have a dividend, but they don't have a PE. They don't have a 5-year PE. They don't make money. They don't make money. They have negative free cash flow. This is going to be one of those companies where the 52-week highs and lows, $373 down to about $73. So let's go see when that was. This is probably all the rage back when it happened. Let's see. So probably in October of 2021, that's where you saw this thing sitting at that probably intraday high of $373. This is probably when the YouTube gurus told you go out and buy this thing. Nothing can go wrong. As of today, you're down about $300 a share in less than a year. So when I see these types of companies, and this is exactly what this is something I really want to cover. When I see revenues increasing, that's great. I like that the company is driving revenue. That is a good thing. Net income. When I see they're driving revenue and increasing that, and you see as the revenue increases, the losses increase. This is normal for a new company, but these losses are massive, and they're going from just 5 years ago, $90 million to $1 billion in losses. This is a company where you look at and you say, hey, do they have a lot of potential? Sure, maybe. I don't know. Is this a risky investment? How can I gauge where this company is going into the future if they have not given me any evidence that they are going to work in my favor? Plus, they've diluted the heck out of you. In 2016, they had 24 million shares outstanding. Now they have 182 million shares outstanding. You own so little of the company compared to your one share that you bought in 2016. It's not even funny. Let's go to the cash flow statement and see if there's anything here that stands out. Again, that net income was negative $1.06 billion. Negative free cash flow of $253 million. Do they do any acquisitions? Because that would be So they do quite a few acquisitions. The last 3 years, they've done 3, totaling about $1 billion, close to $1 billion. Guys, for me, I look at this company. Actually, if I even go, the 8 pillars are not going to light up. The revenue growth is, of course. But if I go to Stock Analyzer, there's nothing that I can type in here. I'm going to probably come out with something in the $1 to $5 range. So it's not even worth me doing. How am I supposed to predict any type of revenue growth that's consistent, any type of profit margin that's consistent? All I would have to do is go and see what other companies in their sector do and kind of base it off of that. But it's not worth the time. I'd rather come over to a company like Verizon. Again, there's a correlation here. Verizon hit a high of $55.50 in April, just this past April. So a couple of months ago. And it's down now to it got as low as $43.50. I come over here in Guru Focus. This article was written May 23rd. So this is about Buffett selling his Verizon. There's a pretty good correlation between Warren Buffett selling his Verizon and it going from $55 to $43. Pay attention to that. Maybe as a value investor, actually as value investors, Paul and I didn't understand his interest in Verizon. We spoke with our friend Gary. He didn't understand the interest in Verizon. When you go and look at the debt levels of Verizon, they're astronomical, absolutely astronomical. Shares outstanding was growing. There was nothing. The return on invested capital is terrible. But now, when I do talk about the debt, you have to say, okay, is this specific to Verizon, or can we look at AT&T? Can we look at T-Mobile? Are we seeing debt levels there? We are. We are seeing incredible debt levels out of these different companies. So with that being said, you can say that it is industry-wide. It's nice that it's not specific. It's like when I go and look at the debt levels of Walgreens. They're not the same. They are the same as CVS. It's because of those capital lease obligations. So here's my hesitation about Verizon. Not a lot of growth over the past decade. Actually, very little growth over the past decade. Net income, very little change in net income. This had to be some type of acquisition. It's $31 billion and they're back to 20. So I worry in that regard. Now, shares, are they helping you or hurting you? They are hurting you. So they are adding shares outstanding. So there's a lot of different things in here. Let me go to Stock Analyzer tool. Now, these businesses to me, I'm always surprised when I see Verizon's numbers come out of subscribers, people that get cell phones, et cetera. I understand there's a new generation always coming up every year, but who doesn't have a cell phone that still wants a cell phone? That's the way that I look at this. So the revenue to me is not going to grow significantly. So let's go put in here -2, 0, and 2. Actually, you know what? Let's put in -2. Do I want to do -1 and 0? No, probably not. Let's go -2, 0, and 1. 0 and 1. Profit margin, 13, 14, and 15. It is a capital intensive business. 5, 6, and 7 for free cash flow. PE, I'm going to do 12, 14, and 16. I don't see how they can grow from here, especially in the space that they're in. I mean, they kind of are in a monopoly space. There's 3 big companies. That's about it in the United States. And there you go. Let's analyze this bad boy. And we come out with numbers kind of all over the place. And this is kind of why I wasn't understanding what Buffett did. Current stock price at the 52-week low, $43.67. If you believe these assumptions from the multiple of earnings, maybe you're in the money. But again, I just don't see it. This is not an investment for me. So if you like looking at these types of things, this is how value investors look at things. Go and look at stocks that have just been significantly beaten down. I mean, this is a great place to start, 52-week lows, and go from there. They could be at 52-week lows for a reason. And I think that I'm seeing these from at least 2 out of 3 of these companies. Now, I want to show you trading. So those of you that are in the bid and ask, I'm going to hit this for you. For those of you that are not in the bid and ask nation, come and join it for a month. Try it out. This is what I'm going to show you on Walgreens. This is pretty incredible here. Now, Walgreens is sitting at what I would consider a very, very strong resistance point. And I put my whiskers there. You see that gray dotted line. I don't really see this thing falling much below this 36 level. And I'm going to dot it in there. We're going back to 2021. Look how much consolidation was in here. This kind of consolidation creates a support level. You had a little bit of a dip right here. It kind of hung. So to me, I'm looking at this saying, okay, I'm going to look at my trend. What I want to happen is my red line to move into the sweet spot. As soon as red line and yellow move into the sweet spot, then I have some type of buy signal on this. And I could probably run this thing up to this 44, depending on what kind of volume this thing gets. This thing does have room to run. But overall, I would just trust my trend. If you guys want to understand trend, hop into the bid and ask. You'll understand it even better. But once my red line and my yellow get into the sweet spot, as soon as people start getting interested in this, this is where you can take an opportunity to go long on this thing. Guys, if you like this type of trading, jump into the bid and ask nation with me. I'll teach you trading. We cover options, of course. We cover value, of course.
Sign up for the bid and ask nation.
Guys, come on in. You'll get endless access to me, access to Paul. It is a great place to be, and there's so many people that are like-minded that can talk about value, options, trading, whatever you want to do. I'll catch you on the flippity flop.